I was going to say, Scott, you look like you came in with a little bit of a lighter spring in your step, and I forgot that the annual election period did wrap up. So a little calm for you before open enrollment begins. But, one thing that doesn't stop between now and then, the holidays, of course, the hustle bustle of that. And then, of course, retirement. That never really stops. People are always planning for retirement, and the market never really stops. And truth be told, we've seen some lift in the stock market lately. But as we mentioned before, bear market rallies, they are common, and we shouldn't get too excited. Liz Young from Sophie tells us CNBC that she sees only one more drop.
Well, if we look at the amount that we've risen over the last month and a half or so, we're up 10% since the end of September. That's a pretty big jump. And look, bear market rallies can be really powerful. I think that if this turns out to be one, this is no exception. If we do have another pullback in the market, I think it's the last one.
So she believes the market is reflecting 6 months beyond the data that we're seeing. So what do you think? Should we take that with a grain of salt? How do you plan with all these differing opinions?
Well, I mean, it certainly is good to see some positive news in the market. And, for those of you that have been listening, we've been talking about what our expectations were at the market after we got through some of the midterm elections. And, we're seeing the history of the market kind of play out here with getting a little bit of a rally. But it doesn't take long, whether you're listening to this show or going online to a website, whether you can get an opinion about what the outlook of the market is. And, sometimes I'll come in the morning and the outlook's pretty negative on what the headline is. And, by the time I go to lunch and look at it in the afternoon, the headlines are, why today's the best time ever to get invested. And, with the 24-hour news outlet, what happens is that can really drive an investor's emotions to make short-term decisions. And, we've been talking constantly about the impact of making short-term decisions can be painful. When you let the market go down and then all of a sudden you kind of get out and then try to figure out when to get back in when things look better, that emotional roller coaster of investing will be painful. So this is exactly what you should be doing if you're looking for, what the prediction is of the stock market in the future. First and foremost, whether you're listening to our show or reading an article, and it could be an article written by somebody who even won the Nobel Prize. What you need to understand is that, first and foremost, the stock market doesn't care what somebody's opinion is. The stock market's going to do what the stock market's going to do. You can use history as a guideline. So if we look at things, what we could say is, going back to the 1950s, we could say that the stock market in the, following year after the midterm elections has historically done good. So that's good things in our favor. We can say, historically speaking, if you look back to 1980 and say, when the market was down 25%, the returns after 1 year on average were pretty good. So using history as a guideline would say the rally that we're seeing right now is normal based upon historical returns. That's not to say that short term we can't have some more volatility. I know this past Monday we saw the market, have a pretty sharp sell-off after the weekend. To try to digest some of the news that's out there. And then also you could say if Washington is divided, history would say that that's usually a good sign for the stock market. The stock market actually likes Washington to be divided. So instead of trying to look for predictions for the stock market in 2023, what should you do as an investor? Do everything you possibly can to stack the deck of cards in your favor. So again, use history as a guideline, but then also make some smart decisions that says, if history doesn't repeat itself, do you have a protection plan in place? And, what is the maximum level of risk that you're exposed to in your portfolio? We use some software where what we can do is we can take a look at, what the historical good times and bad times would look like in the portfolio. What is the maximum level of drawdown that somebody could have in a portfolio? So if you're maybe down, 10, 15, 20%, and you're getting to feel very uncomfortable, if it is a 2008 environment again and the stock market really continue to go down after this near-term rally, what is the maximum level of drawdown that your portfolio could suffer? If you don't know that number, you need to know that number, and that's what our software can help you analyze. The other thing we take a look at is we take a look at how much the way that your portfolio is allocated, does it allow you to participate when the stock market goes up? And how much does it participate when the stock market goes down? So in the perfect world, if such a world existed, you'd want to participate in as much of the good stuff as possible and then you'd want to avoid as much of the bad stuff as possible. We had a client that took us up on one of those independent portfolio analysis, and we were taking a look at it, and he got about 103% of the good stuff. So when the stock market did good, he performed like the stock market. But looking at the analysis, he was taking 122% of the bad stuff. Whoa. So he historically was going down faster than the market was, and those numbers are kind of flip-flopped, right? So you'd want to know that you're getting like 90% of the good stuff and taking, say, 70% of the bad stuff. And the portfolio statistics that are out there in creating the independent portfolio analysis are the way to put those odds in your favor. That way you're in a position that if the market does perform good in 2023, which I'm optimistic about, but again, the market doesn't care. But if it does do good, you're in a position to try to capture as much of that good stuff as possible and then avoid the bad stuff. So if you don't know those numbers, what I would encourage you to do, if you've been listening to the show for a while, or maybe this is the first time that you're listening, if you want to know the odds are in your favor or if the odds are against you in your portfolio, give our office a call. We've done a great job communicating this. We'll do that same offer that we just recently did that got so many people calling in and asking about it. For the first 5 people that give us a call, we'll do an independent portfolio analysis, and we'll show you where your portfolio lines up with the maximum level of risk, with what the overall investment allocation is, how much you are able to participate when the market goes up and how much you're participating when the market goes down. Just call the office. You can get to that independent portfolio analysis. And again, first 5 people that call in from the show, we'd be happy to extend that offer to you.
So, Nolan, I actually have a question for you. So you were talking about how you strategically prepare for situations like what we're in right now. But how often, over all of the years that you've been in this business, which, 20, 28 years or so, and you've seen the highs, the lows, the 2008s and that, how often does a client, once the market rebounds, how often do they make drastic changes to prevent from that happening again to their portfolio?
Well, as we talk about, you don't want to make drastic changes at the bottom.
Right.
Or, even drastic changes at the top. You don't want to chase results, nor do you want to lock in losses and be in a position. At the same time, retirement is a different point in your life. It doesn't allow the luxury of time to make up for mistakes.
Exactly.
So as somebody is younger and they're saving and accumulating money in their tax-deferred retirement account, losses don't feel good on their statement either. Mm-hmm. But the reality is they can buy more and more and more. It's when you get into retirement time, if you think about the risk that a retiree faces, one of the biggest risk a retiree faces is called the sequence of return risk. And that means taking negative results big in those first couple of years can accelerate the risk of them outliving their money. So those people that are taking withdrawals from their account, they really need to be the ones that are focused on downside risk management. And this is the type of environment you really want to be looking at downside risk management.
And that's where that independent portfolio analysis really comes into play. I understand that, you may not have really given a lot of thought to risk in the past 14 years, aside from 2020 on, where it's really kind of crept back into the picture. And that is because it really wasn't an issue. But here we are, older, wiser. Hopefully our portfolios have grown significantly since 2008, 2009. But we're also closer to retirement. And if and really when that volatility creeps back into the picture and becomes a bigger issue, how are you equipped to handle it? That's where that independent portfolio analysis comes into play. Don't forget, complimentary if you're one of the first 5 callers this week. Take advantage of that and see, if there are some changes that need to be made, find out about it sooner rather than later, and you'll be set up all the better for it down the line. For first 5 callers, complimentary, 419-794-3030. Once again, that's 419-794-3030.